Hi, welcome to What Are Your Financial Statements Telling You? I am Keith West with AOPA, and a little bit about my background is I am Senior Director for Flight School Business Support. So I work with flight schools to help them have better flight training experiences for their students, as well as having better business outcomes, for you as business owners and managers. And just a little bit about my background, I have been a small business owner and a flight school manager for a number of years. For about 20 years or so, I have been using QuickBooks. And although I am not an accountant, and I will say that right up front, um, I do have a lot of actual practical experience, and sometimes I think that maybe helps a little bit because I don't have the academic background in accounting. So when I have to look into accounting, it has to be explained to me in ways that are practical, in ways that I hope will help you. So let's get started here. And what are we going to be talking about today? First of all, why have financial statements? What do they do for us? Then we're going to go over some accounting principles. And I tell you, when I first encountered these principles, a lot of things made sense because, quite honestly, I would put transactions into QuickBooks on, either bills or invoices or what have you, and I would kind of glance at the financial statements, but I really didn't understand what was going on in the background. But over the years, as I have decided to research more and read books and understand more of what's going on, I found a little bit of knowledge of these accounting principles really helped. And then we're going to go over the three financial statements, okay? And we'll delve into those and from hopefully an understandable perspective. Let's back up just a little bit and talk about bookkeeping and why it's important. Of course, first of all, you want to keep records of your financial transactions. Uh, who are you paying? Are you paying your bills? Who do you owe money to? How are you invoicing your customers? All those sorts of transactions. A business is really a collection of transactions, and having some idea of how to keep track of that makes it much easier to understand our business. Of course, our bookkeeping provides a basis for tracking key operating data. Where's your money going? Where is money coming from? So all that key data is built on good bookkeeping. And let's not forget, it's a basis for external users such as banks or investors. And when we say regulators, we're specifically talking about the IRS at the very least, because you have to be able to pay your taxes, and it's hard to do that if you don't have a well-formulated set of books. And the one I like the most is that when you learn what you're looking at, you can use it as a basis for making business decisions. And we're going to go over as we look at each one of these financial statements, we're going to bring up some questions that statement should be able to answer for you. All right. Before we jump into it here, I want to reference a couple of sources that I highly recommend. This presentation here was built with references to these two books, but what I like about them is that they're all very clear and they talk in non-accounting jargon and they define their terms and just explain things very well. And so I would suggest for anyone who owns a business or is a manager in a business that has responsibility for finance and profit and loss and that sort of thing to look up these two books, and they're available on Amazon for just a little bit of money, $15 or something like that. Okay, terms. I think that the terminology in accounting is one of the things that's off-putting because what's kind of, I don't know, it's still a little bit perplexing to me, but you have sometimes multiple terms meaning the same things. And I'm going to give you a couple examples here. So sales and revenue. Sales and revenue equal about the same thing. It's the top line on your income statement, which we will jump into in a little bit. These three I found confusing for a long while until I looked into it, but they mean the same thing: profit, earnings, and income. Now, on the other hand, there's some things that seem like they might mean something similar, but they do not. So let's look at non-synonymous terms: revenue and income. Now, that's one that I think a lot of people get confused about. And so what is the difference between revenue and income? So revenue is that top line. It's all the money that has coming in from whatever sources that you derive your money from. Income is after everything has been subtracted out. It's at the bottom. It's what you're left with at the end of the day. So, and this is one that I've spent a number of years thinking they were the same thing, and they're not actually. Okay, so cost is like, and I'm going to say expense, but the money that you use to deliver to specifically for your service. So let's talk about airplanes in general. Your cost would be the cost for operating, the money that goes into operating the aircraft, the money that goes into paying the instructor, like fuel cost. All those are costs because they're specifically tied to the production of your service. So how is that different from an expense? An expense, and I like to think of it this way: on a rainy day when you don't fly at all, the simulator is not doing anything, you still have certain money that you're going to have to pay to keep the lights on, the rent, paying the person at the front desk or any administrative people. All those are expenses because they're not tied directly to the production of your revenue. Think of them as overhead. But cost and expenses are two different things, and we'll take a look at how that comes out in a financial statement. Wow, this one too, profits and cash. And this one gets a lot of people in trouble because just because you have a profitable business does not mean that you have cash. There's plenty of profitable businesses that have to file for bankruptcy or are not able to continue operations. And that's mostly due, and we'll talk about it in a little bit, to the timing of the money. Because you don't, let's say that you're going to well, let's make it germane to a flight school. You have to buy the airplanes, so you have the airplane, and you put money into that, or you put money into your rent, for example, or whatever other facilities that you might have to have, um, and you're not getting that back right away. The cash will come in slowly. It'll pay itself off over time. So that investment, that timing, and so like businesses that have large projects where maybe you get a big contract, and to fulfill that contract, you have to staff up. You maybe have to buy machinery or equipment or something like that, and it's not going to pay off till sometime down the road. And so, although on each little increment of whatever it is you're producing, you may show a profit. It may not matter if you do not have enough cash to sustain those operations and to support the investment that you have to make up front to be able to deliver your service. And that's just what we're talking about here: profitability and solvency. Are you solvent? Are you able to continue the operations? Do you have enough money in the bank to pay people and cover your expenses and that sort of thing? You might be profitable, but if you don't have the cash, you're not going to be solvent. So cash is king. That old saying that comes back to that. So let's just take a minute and just kind of go lightly into 12 basic accounting principles. First, this makes easy sense. Okay, some of these are kind of obvious, I think, but we're talking about an accounting entity. Okay, it's an LLC, it's a corporation, it's some sort of collection of business that's not actually you. Right. And so that's where one of the things that will get small business owners in trouble quicker than about anything is to mix their personal expenses with the business expenses. And so an accounting entity is supposed to be separate from you, the business owner or manager. It's a going concern. And so that means like there's no set end date. I mean, hardly, I don't know of any business that's actually infinite in time, but when accountants look at this, they do consider it that it's an ongoing over like an indefinite time period, and that makes the accounting actually doable. Measurement. You have to, in accounting, and I think, and this is one of the things I found really interesting, you have to be able to measure whatever it is that you're accounting for. And so, for example, you have your customer loyalty. You have loyal customers, all right? Now, intuitively, that's worth something, okay? But how do you put a number on that? You can't really account for it. And so that's why, what we call book value of a business, and that's if you take a look what's in your accounting books and what those numbers would say a business is worth. It's quite often worth actually more than that because of these intangibles, but they are not accounted for because you can't. There's no real way to measure that. Units of measurement, that's pretty obvious. We use dollars. Historical cost. This is another interesting one that will result in a business actually having a different value than what it says on the books. Now let me give you an example. Let's say that when you were getting started, you bought a hanger, okay, and you bought it. I know you can't get a big hanger for $100,000, but just to make it easy, let's say it's $100,000. But you bought that 10 years ago, okay, and for $100,000, and you've used it all this time. And so let's say now it's worth $400,000. But that's not the way it shows up on your books. It's still at $100,000. And so one of the reasons that we do historical cost is because, when you really get deep into it and you're trying to make a judgment on what things are worth, we have to do things that make it easier. Okay. And using historical cost is one of those things that we do to make it easier, because if you were having to revalue all of your equipment and your facilities and your real estate all the time to be able to show that on the books, there just comes a point where that's not really doable. So materiality, and I I fumbled that one. That's interesting too, because I have seen people in businesses or flight school, actually maintenance shop that I worked at. Somebody was counting the washers, and it's like, well, it took them more of paying them to count the washers than the washers were worth themselves. It really wasn't material to what they were doing, and so that's one of the things that we assume, that we don't have to account for every last penny, because it just becomes too much of an effort, and it costs more than what you would get out of it. So another thing is that we use our best estimates and judgments. It's not always, since these things aren't necessarily cut and dried, and that's where the art of accounting comes in. It's like it's not pure science, and so sometimes we do have to like kind of make an estimate of what something might be worth or how we should handle it. No matter how you go about doing that, you need to be consistent, right? And so, if you're first of all, if you're not consistent, you're not going to be able to understand what your business is doing over time, because you change the rules in the middle of the game. So consistency is one of those rules to that makes it actually better for you over time to be able to understand what your business is doing. And one of the examples I've used related to this estimates and judgment and consistency is like, if you know, you want to be able to account as closely as possible what how much effort and how much money and resources that it takes to produce your service. Okay, so our service, is flight training. Okay, and so one of the costs involved in that is obviously fuel. It's also the guy who or person who puts the fuel in the airplane. How are you going to account for that? Because if you really think about it, it's a variable cost, because it's as you're flying, as the plane is being refueled, human effort is going into that, and the more you're flying, the more that person out on the line is going to put spending effort to put the fuel in the airplane. And at some point, you can make an argument. Well, that is a variable cost, and every time we fly, we should be accounting for how much effort was done there. But see, that becomes really it becomes too tangled. It becomes too difficult to do, right? And so we typically just say that is not a cost. It isn't variable; it's an expense. So whatever salary or wages that are paid to the line people typically get put into the overhead and are not divided down for each individual flight. And that's just an estimate and a judgment that we make. And so that's kind of gives you an idea. I think it's a good view overall with accounting, that it's not always as precise as it necessarily could be, but we think, okay, this is close enough. Conservatism. Okay, that has nothing to do with who you vote for in any election. What it does do, what it mean is that you take, and let me give you an example because it's better to say this. You do not recognize revenue until it happens. Okay, and so until that service is actually delivered. So let's say that somebody comes in, and I've seen this happen a lot. They say, I want to put down $10,000 to get my private pilot's license. Okay, great. Do you recognize that revenue right away? No, you do not. You only recognize that revenue as those flights happen. Okay, and so that's the conservative way of recognizing revenue. Now, on the other side, the cost side, when it is reasonable, you think that a loss or a cost is going to happen, that should be put in as soon as it seems really likely that that's going to happen, the loss or the cost, not not somewhere down the road. So that's what we mean by a conservative, going in a way that, like, I would say is most detrimental to the business. Not quite that, but that's the way to think of it. Periodicity. I guess that's the way you'd say that. But it's in time increments. So whether you do your books on a monthly basis or quarterly or annually or whatever, we look at the business over a defined period of time. Substance over form. That means that if something walks like a duck and quacks like a duck, we're going to call it a duck. So an example of that would be like if you have a purchase that's disguised as a lease. And so in that case, you would actually look at it as a purchase because the substance of it is that you're buying that particular piece of equipment or whatever it might be. And then the accrual basis of presentation. And I think that's one of the harder things to be able to grasp, but it's because these transactions happen over some period of time. You've got to figure out how to make that work out, because what you're really trying to do, and I believe that will come up in the next. Well, first of all, revenue recognition, just like I said before, like if you're producing a physical product, you can recognize that revenue when the product ships. And so I would say that we in the flight training industry, when the flight is completed, that's when you can recognize the revenue for that particular transaction. Now, the other thing is the matching principle, and this is really interesting to me, and too, is because you want to match where the revenue and the expenses are as reasonably as you can possibly can. And so let me give you an example. So we have insurance. Of course, insurance is a big cost in flight training, and so you may get a bill once or twice a year, right? And so if you're following your principles and if you're matching, you would say you get a yearly insurance, you divide that up into 12 increments, and then every month you allocate that expense to your expense side of the income statement, so that the revenue is matched with the expense, and that makes it where your income statement is not so lumpy. These wild swings, and you can say, well, why in June are my expenses so high? Well, it could be because you're paying all your insurance in June instead of spreading it out for the year. So the matching principle, you match your revenue with the expense. And then allocation. So how are you spreading out the various it kind of goes to what I was just talking about, like with insurance. Where are you allocating that expense? And you could do that with like with your airplanes too. How do you allocate those expenses? That's what depreciation is all about, and we'll touch on that in just a couple minutes here. All right, so what are the financial statements? The income statement, it's sometimes called the P&L, or profit and loss statement, the balance sheet, and the statement of cash flows. So we're going to dive first into the income statement. I think it's the most intuitive and the easiest to understand. Now what it's telling you is like what's sold minus the cost to make it, that's the variable, and then minus the general expenses, and at the end, that's where you get your income. Now let's look at it in a different way with the language closer to what we've been talking about. Sales minus cost and expenses equals income. Now remember, cost is the variable cost that can be attributed to that next increment of your production, whereas expenses are the overall overhead of, like I said, like your rent and the utilities, etc. Now, an income statement is all about profitability. Are you making a profit? Meaning, for each hour of instruction that you give, are you coming out ahead? Are you receiving more than you expend to deliver that hour of training? Now, this is interesting. Okay, it's nothing about when you receive the cash or how much cash you have on hand. right? So that's why businesses, because of that difference there, is because businesses can get in a cash crunch, even though they're profitable, because the income statement doesn't tell you anything about whether you actually have the money or not. And so, if you only look at the income statement, that's something that could end up get you in trouble. So let's delve in just a little bit more into expenses, and then we'll show where they show up on an income statement. So let's what might be your variable expenses? Now, instructor pay. Now, see, this is one I have seen, probably several dozen financial statements from flight schools, and almost no one allocates the instructor pay to the cost of goods sold. And so what that results in is that, so let's say your top line, your revenue was $1 million, and then cost of goods sold, there's might be a few things in there, but you're showing then the next line after you subtract whatever out that put in there, you might say, I'm making an $800,000 gross profit. Well, that's just not true. I mean, and so the gross profit is showing after you've produced this service and you put all that money accounting for every expenditure that you have, then my gross profit is the profit that I have before taking out all my expenses, all my overhead, right? And so if you're not making money, if you don't actually have gross profit, then you're not going to be profitable on the bottom line either. Okay, so it's really important to understand, because it tells you how much you are spending to be able to deliver that hour of flight training. And so that's why, like, including instructor pay would be, I think would be a good practice. Now, then instructor taxes, instructor workers comp, aircraft fuel, aircraft oil, and then I put a question mark for aircraft depreciation. I don't know that I would personally put the depreciation right there, but you could certainly make an argument that to do so, because you buy an airplane, let's say that you just buy it outright, okay, and it's going to last you, let's just say, I think they depreciate over, what is it, 6 years or something like that. But if, let's say it's going to last you 10 years, that you planned on using that 10 years, right? So you put all this money in, but how are you going to allocate that over time, the cost of that resource, so that you understand how much money that you're actually making from that hour of flight training? Because it can get really complicated, because airplanes are expensive to operate, and are you not doing yourself a favor by not accounting for all those costs that you're putting into the instruction, which would most likely be hidden in the operation of the airplane? Okay. So the other side of expenses would be the fixed expenses, okay? And those, like I said, are the ones that you are going to have whether you got a rainy day or not, okay? And so management pay. So managers are considered an expense, because you can be sitting there managing whether anybody's flying or not. The same for administrative costs, rent for your facilities, insurance, and also your marketing costs. That is considered an expense. So what does a income statement or P&L look like? This is a very simplified one. It can be more complex than this, but this gets the general idea. So let's say your revenues are $10,000, and then your cost of goods sold, remember those are the variable expenses that we were talking about, those were $5,000, right? So if you subtract the 5,000 from the 10,000, that leaves you $5,000 of gross profit, your profit before expenses. So let's take out the expenses. So your facilities, or whatever your expenses might be, and let's say those are $3,000. Okay. And so then here's depreciation too. And so depreciation is considered, it's a non-cash expense. So because you're not actually having to write a check for depreciation, right? It's a way of allocating the expenses that you've already made, the expenditures you've already made. And so in this case, you end up with a net profit of $1,000. And so every income statement is pretty much like a more detailed version of this, but those categories will be there. So what can you learn from your income statement? And so we can answer questions like, how much does it cost to deliver my service? And that's really important to know. And so that's why it's spending the time to get basically get your chart of accounts correct, and make sure that when you record a transaction, that the monies are being assigned to the right accounts, and that will be able to tell you, if every time that somebody takes off, am I making money on this? Because if you're not making money, then you can't doing well at that level, then you can't be in business. All right. And then another thing it might answer is, what service is making me the most money? And so let's say that you have, like, maybe you do sport license and private, or you do VA flying, or maybe higher education, something like that. So you can, if you have it all allocated right, you can take a look and you say, well, I'm making the most with these college students, for example, and so I'm going to focus on that. And so knowing which of your services is making you the most money allows you to focus and to optimize. Another question it might answer is, how much do I make per customer? Because underneath there, you would have expand that. You would have the individual customers, if you wanted to go to that level of detail and find out, who is making me, or mostly what type of customer is making you the most money, whether it might be somebody on a professional track or whether it's your local leisure flyers. All right, let's go to the balance sheet. So what is a balance sheet? And so this is a little bit more difficult to wrap your head around, I think, than an income statement. It is not quite as intuitive. And so a balance sheet is a statement of what a business owns and what it owes at a particular point in time. Because obviously, if like this month, you might owe more or less than the next month. So whereas a profit and loss or an income statement is over a period of time, a balance sheet is at a particular point in time. So I'm going to give you an example here, and I'm going to relate this to home ownership because I think it's something a lot of us can relate to. And so let's say that you live in your house, okay, and it will sell for a particular amount of money. Say that you go on Zillow and you see and that your house is, I'm just once again an easy number, $100,000, okay, and then you say, well, my mortgage on it, I owe $80,000 on my mortgage, and so that $20,000 is how much equity you have. Okay, and so this is really the foundation. This is the idea that a balance sheet is built on, and the way they express it is assets. That's the asset. That's what the price said on Zillow, minus your liabilities, which is the money that you owe the bank, and on the assets minus liabilities, that's equal to the worth of your house, or the equity. Okay, and so this is the way a balance sheet is too, although they just move it around a little bit, because if we add liabilities to both sides, it will, if we go back to our algebra, and if you add liabilities to both sides, then it will cancel out on the left hand side, and what you will have is assets equals liability plus worth. And every once in a while, I look at that, because that final version of the equation, it kind of hurts my head every once in a while. But when I go back and think, okay, it's just what I have versus what I owe, and that's what I own, and that's all the balance sheet. That's what the balance sheet is really doing for you. So let's take a look at a balance sheet, okay? And why is it balanced? Is because one side has to equal the other. And let's look at all the various elements. So on the left, we have assets. And on the right, remember, equals liabilities plus equity. Okay, equity is is basically the ownership that you have in the business at this point. So at the top of the assets column, and the balance sheet is organized from top to bottom, things that are most liquid to least liquid. And of course, nothing is more liquid than cash, because you can sell it. You can exchange cash very easily. Of course, something that would be very not liquid is real estate, because it's harder to exchange, right? So going from cash, okay, and then accounts receivable, right? So that's people who owe you money. That's an asset. They owe you something and they haven't paid it yet. Fortunately, most flight schools are more like cash businesses. Excuse me, meaning that when the service occurs, then that's where you get paid for it. All right, something that would be a little bit less liquid is inventory. Once again, except for maybe your shop, Except for maybe your shop. Most flight schools don't have a lot of inventory, but you might have a flight train, your little school store there. And so there could be some inventory there. And of course, that's not very liquid because you can't just exchange your inventory right off the top for cash. It's something that is harder to exchange. And then prepaid expenses. And so a prepaid expense was just like what we were talking about. So you pay your insurance for the whole year, then you allocate it out over the year. Well, that is a prepaid expense. And so then if you take all those and add them up, those are your current assets. Okay, now underneath, then there are other assets. Okay, and so other asset might be that you have maybe a certificate of deposit or something like that. Then we get down to fixed assets at cost. Well, that would be your airplanes would be in that category, any type of real estate that you might own. And then underneath there, accumulated depreciation. So you buy the airplane, $100,000, and you're going to depreciate it, let's say $10,000 a year to make it easy. And if you've owned that for 5 years, then you've accumulated $50,000 of depreciation on that particular asset. And then you would have a schedule under there for all your significant assets so that it takes account of that. And then add all those up, and those are your net fixed assets. And then you add this top group here with your liquid assets, and then your fixed assets. Then that's your total assets. You know, that's the biggest part, the biggest number that you could manage, that you have. Now we look on the other side of it. You know, what do we have to subtract out of this? Okay, so there's accounts payable. Those are bills that you owe that you haven't paid yet. Okay. Then accrued expenses would be like pay for your employees. Current portion of debt. Okay, so you have long-term and short-term debt. Current in accounting means the debt that you owe within the next year. So if you have a mortgage on properties, notes that are due on aircraft, that portion which is due within the next year will be under this current portion of debt. And then income taxes, you know, so you have to pay your estimated taxes quarterly. So then within the month 1 and month 2, month 3, before you actually pay it, those amounts of money would show up in this account here, and until you paid it, and then that would zero out again. And so you add all those up, and those are your current liabilities, what you owe within the next year. Then there's long-term debt. So like we say, your mortgage, the notes on your airplane that are due more than a year from now. Capital stock, that's the money that you put in the beginning when you put down $10,000 that you put into your entity to start your business. That's your capital stock. Now, your retained earnings. Okay, so I'm going to show you in a second that all these financial statements, they relate to each other. So retained earnings is the amount of your net profit that you have accumulated that you haven't paid out to yourself or your partners or other investors. That's the money that has stayed in the company, and you add up those things right there, and that's where you get your shareholder equities, just like the equity in your house. And then you add up all your liabilities and equity, and that shows a number over here on the right, and it has to equal your total assets over here on the left. So that's why we say it's in balance, all right? So they have to equal each other, because remember, that is an equation. So if you change the numbers in one of those categories, it has to change something on the other side to be able to stay in balance. So the income and balance sheet are linked, right? So most changes that you have in the income statement causes a change in the balance sheet. And just like that example we gave, where you have profit within a particular month, that's going to show up in your retained earnings on the balance sheet. And just the same, like I said, a change on one side of the balance sheet necessitates a change on the other side of the balance sheet. So what kind of question can the balance sheet answer? Things like, how much do I owe and what's owed me? All right, so now let's move on to the cash flow statement. So this is one that a lot of people pay. Some business owners manage their business purely on a cash flow basis, and it's more of an intuitive way to do that. But because and actually Warren Buffett says what he looks at is cash flow, because what it's showing is the amount of cash that you have from period to period. Let's say month to month. So it tracks the cash through a business over a period of time. So just like the income statement, it is. Well, in fact, if you're doing your accounting on a cash basis, the cash flow statement and the income statement are the same. But because when you use accrual, which most businesses do, that's where it changes. So let's see what the cash flow statement looks like. Okay, so it's cash on hand at the start of a period plus the cash received during that period. So you had $10,000 starting the month. You made $5,000 this month. You're up to 15, minus whatever you spent in the period. And so where all those on the income statement, there was a lot of we talked a little bit about allocation. When you actually make the expense happen, that takes that part away. It's just the checks you wrote, or the money that came out of your bank account. And so that equals cash on hand at the end of the period. So it's basically looking what happens to your bank statement from month to month. So let's see what it looks like. So cash flow statement, this is the format, and it will say period X through period Y. So your beginning cash balance, then you have cash receipts, money coming in, cash disbursements, money going out, cash from operations. So then you can see that B minus C equals D. D is cash from operations. That's what you make from from sending instructors and students out. This is the money that you make from that. That's D. So then you look at the next part of it. So did you buy any fixed assets during that period of time? Did you borrow any money? Because if you borrow money, it's not the same thing as making money. So you want to be able to look at that in a different way, because you want to take that into account. Then any income taxes you paid, and if you sold any stock, did you bring any money in from selling a portion of your company to somebody? So your ending cash balance then is A, and if we look back up at the top, that's beginning cash balance plus D, which is your cash from operations, minus E, the fixed asset purchases, plus F. So if you borrowed some money, minus G, which is your income taxes paid, plus H. Okay, and so all that should add up to your ending cash balance. And the reason that we break out this second group, the fixed assets and the borrowing and income taxes, etc., is so that somebody who's looking can understand, well, this is why their bank account got bigger, but look, they borrowed all this money. And so that explains what is happening in the bank account. Okay, so what can you learn from a cash flow statement? And so questions such as, how much money do I have? That's what you want to look, because I've seen people get in trouble looking at their income statement, or even certain ways you can look at the balance sheet, and it's not really showing it. Well, let me give you an example. Okay, so if somebody who puts down that $10,000 and prepaying their flight training, how's that going to work out? Are you looking in the right place? Because it would be bad to spend that money because you don't really have it. Okay, and so then, am I making money? So is the cash flow statement, is it showing more at the end of each month? Because if you're managing on cash flow, you're less likely to get in trouble than using your income statement. And over time, it will tell you, am I generating or consuming cash? Well, but of course, that's an important thing to be aware of. So other questions that you might have, you have to use a combination of these three statements. And so if and a few of these have other considerations that you might do. So like, should I buy an airplane? You can come up with a kind of I'm going to call it like a spitball answer by looking at your financial statements. You might want to do something more complex, like a discounted cash flow, where you're looking at how much cash this asset, being the airplane, will generate over time. And if you use certain metrics, then you can come up with a number and say, okay, I should buy this plane, or I shouldn't. If you don't want to if you get that sophisticated by looking at your income and your balance sheet, should be able to tell you a lot. Should I own or lease my airplanes? Okay, and so that's a big question, because the good thing about a lease of an airplane, if you're going to lease an airplane, then what you're really doing, if you think about that, is you're transferring it from an expense. Remember, expense is overhead, to a variable cost, because you're not having to pay for all of the airplane up front. There's no down payment on your lease, and you get to make that a cost versus an expense. Now, if that airplane, when you're first getting started, and you don't have a lot of money to make your operation, to set it up, well, then it makes perfect sense to lease it. But you probably will get to a certain level where a lot of money is going out in the lease, and you have enough money on your balance sheet now to be able to buy that aircraft. Well, then you buy your aircraft, and that's going to increase your gross profit, which in the end you can make more money. But once again, it's not a cut and dry decision. You have to look at what stage you are in the growth of your school. But by setting up your accounts correctly, you're going to be able to understand and answer these questions. Should I hire new staff? Somewhat similar to an airplane, except of course it's not you don't buy them all up front. Should I advertise? And that would be like a combination of, do you have the cash to advertise? Is it going to help, of course, your bottom line? How your P&L. So you look at that. Or should I bring my maintenance in house? So once again, that's really a question of, is maintenance, can you put it as a cost, or is it an expense? So if you are paying the shop across the way to do it, then it's a cost, and it's variable, and it's somehow related to how much you're flying. Whereas if you're going to buy or going to hire an A&P, well, then it becomes an expense, because it's overhead. Because no matter how many, if you don't fly any, say it's a rainy month and you don't fly all that much, well, the A&P might not have all that much to do, and so the expense might drag on you. So you'd have to be in a strong enough financial position to consider these ups and downs about what type of financial structure you want to have, as you're running your business. All right, well, that's it. I hope it helps some. You got something out of this. And like I said, I'm with AOPA in the You Can Fly division, and we have Flight Training Advantage. And one of the what we offer with Flight Training Advantage is training, and specifically for flight schools. And so our first course is a 2-day workshop. It's customer service for owners and managers. And we have conducted that course a number of times over the past couple years. And quite often it's in Frederick, so it's a 2-day course, and it's designed for anybody in the flight school. Send them and get training on customer service, because in looking at and talking to flight school owners and managers, that was the number one issue that came up, is that they needed their employees to have better customer service skills. And what we do is we go through what makes good customer service, and what would be the plan for you to deliver better customer service. Well, in doing that course, one of I guess the most requested or the most feedback that we got was like, wow, we would like to really be able to deliver the same type of training to our flight instructors, because flight instructors are on the front line of delivering customer service. But of course, my instructor's only going to be with me for 18 months, so I really can't afford to send them somewhere for 2 days. So we said, well, we can help you with that. And we are just finishing up turning this into between a 4 and 5 hour course that was delivered online, and it's specifically for instructors. And so we're really excited about that, and we hope that you will take advantage of it. Then there is marketing for flight schools. That is a 1-day course that we have developed developed to deliver in person, but we also do it online as well, a couple times a year. And been working right now on accounting for flight schools to take some of these concepts that we have talked about, in the last 45 minutes or so, to be able to turn it into a one-day course. And all of these trainings that we do, we want to take a very practical approach, because I think that we've all been in the situations where we go to classes or seminars and you get all excited and you think, I'm going to do this and that and the other. And then you go away back to your business, and it kind of, you lose the momentum or get distracted by other things. So every one of these courses that we have, you walk away with a plan, whether it's like the 1-year marketing plan that we develop in the marketing course, and accounting, exactly, what do I need to do to work with my books to get better information from what I'm doing. So if you're interested in any of these courses, feel free to send me an email or give me a call, and there is my number. Or also sign up for Flight School Connector. And Flight School Connector is an online event that we do the first Wednesday of every month. And if you'd like to be put on the list, it's an online forum where we cover news of the industry and a training topic for each month. And then everybody, school owners and managers, can share information among themselves. And so it's a great way to meet other flight schools and to see what they're doing and how they're solving particular problems. Well, I really enjoyed giving you this presentation today, and we'll hope to see you in our future classes. Thanks so much.